So I won't blame Justin Trudeau 100%, because some of these changes are in the works for a few years already. But sure, if we want to blame him, let's blame him. So what I want to talk today is just give you a brief overview of some of the changes that have been announced just very recently. On March 22nd, the budget came out, and there is one major thing that will affect all of you guys, and then there's small business rules that may or may not affect you depending on how your business is structured. So the major rule change is regarding eligible capital property. Now, what is eligible capital property? For you, it's your quota. You may have water rights, that's also eligible capital property. Goodwill would also be in that bracket of eligible capital property. And there's a couple other small items that I won't need to touch on here. So currently, the regime works that all of this eligible capital property gets pooled together, and you get an annual deduction for tax purposes on your quota. If you sell your quota, that will result in business income, which is taxed quite preferentially, in fact, because you will get a capital gain. It's kind of treated like a capital gain in the sense that only half of it is taxed as active business income, so it will get taxed the same as your milk revenues. But the other half of that capital gain is going into your capital dividend account, which gives you a tax-free dividend to yourself. So that's the current regime. The new rules that have been proposed and that were started, discussion started on this in 2014, is that this eligible capital property is going to be treated like any other of your equipment. So it's going into a capital cost pool. You'll still get a deduction. The deduction works out to be exactly the same every year as it is now. So no change if you have quota, hold on quota, and never sell your quota. No change, you're not affected. Where the changes are is when you sell quota. Oh, that's an example. So in the future, starting January 1st, 2017, if you sell quota, it's actually going to be taxed like a capital gain. So what that means is capital gains are taxed as investment income. It's not business income anymore. And investment income gets an extra tax. Basically, in simple terms, you're getting taxed on that capital gain for the corporate portion as well as your personal portion already. So with regular business income, you only get taxed on the corporate portion, and if you leave that money in the company, you don't pay any personal tax on it, right? But with investment income and capital gains, you kind of pay that personal tax up front already. So a tax rate of 50% will apply to capital gains, which is much higher than the 13.5 or 27% that we're doing for active business right now. So let's just go through an example, because that's much easier to follow, I'm sure, than just listening to me. Let's say you bought quota in 1995 for $1 million. You have taken deductions on your income for all those years since 1995. So your total deductions since then up until now were about $600,000. Now in 2016, you're going to sell your quota for $6 million. All of those previous deductions of $600,000 that you have claimed over the last 20 years are going to come back into income. That's the recapture of it. So that's going to get taxed at your normal business rate, assuming that you don't get the small business deduction for this income, because you're either not eligible or you already have $500,000 of other source of income. Your tax rate is going to be 27%. So your tax liability on just that recapture of those expenses is going to be $162,000. The other part of it is that you have a capital gain. You sell for 6 million, whereas you bought for 1 million. So there's an increase in value of 5 million. That's your gain. So currently, that $5 million gain, half of that is taxed as active business income. Taxed at 27%, you pay $675,000 of tax on it. The other half is not taxed. And it actually goes into your capital dividend account, so you can pay yourself a tax-free dividend. So currently, if you sell today for $6 million, your tax liability will be $837,000. If you wait until January 1st of 2017 and you don't do anything about it, you actually have a tax liability of $1.4 million. And that is because the capital gain is actually taxed like investment income in the future. So there's a 50.67% tax rate on that capital gain. That's where the difference is. The recapture of $600,000 is going to be the exact same as it is today, will be tomorrow, okay? So really, if you wait till January 1st and you plan on selling today, it just costs you $592,000, okay? Now, this only really matters to guys who are planning on selling their quota and plan on leaving the money inside the corporation. Because if you take the money outside of the corporation, you're going to incur personal tax anyways. So then you're mostly indifferent about the new rules. But most people, if they get $6 million, they don't really go on a spending spree for $6 million. So they like to leave that money inside the corporation and enjoy a deferral. But that deferral is kind of out the window unless you do some planning. So if you are thinking that you might sell quota in the next 5 years, you should really talk to your advisor, because there are things that we can do, and there are methods around this increase of tax so that we can make sure that you're taxed under the current regime and not under the future regime. The other big change that might affect you is with respect to small business corporations. Basically, the government found out that there's a lot of plans out there and a lot of people out there who are multiplying access to the $500,000 small business deduction. And that $500,000 is significant because you pay 13.5% tax instead of 27% tax in Alberta. So they have come up with a couple new anti-avoidance rules to basically put a stop to that, but they've made the rules so broad that certain things fall into those rules that really weren't planning strategies to gain multiple access to the small business deduction. So what they're proposing to do in the future is that any corporate income, any income that your corporation receives from a corporation related to it or from a partnership related to it, so that can be your son's company, that can be your wife's company, that can be your other company, but any money that goes from one company to the next for certain sources of income will not qualify for a small business deduction anymore. So that would be management fees, custom work, interest income, just to name a few. The other thing that they're changing is the calculation of taxable capital. So what that refers to is how big is your business, and are you still a small business corporation? Basically, it looks at your total equity, your total liabilities in your corporation to see if you're past a $15 million threshold to be considered a small business or a large business. So the scope of which businesses they're looking at is just getting more and more broad. So it will capture more corporations than it does today. So therefore, your corporation will reach that $15 million limit just much sooner, and you won't be considered a small business corporation anymore. But of course, this only applies to you if you have a corporation and if you have other corporations within your group, then these rules will apply to you, and you should talk to your advisor again to make sure that you're working around it and that you're aware of the rules. But this is just a brief overview of some of the changes that were proposed last month.